Imagine you're just driving to work. It's a normal Tuesday, and suddenly you hit this massive pothole.
Oh, the worst.
Right. You hear that awful crunch, you pull over, and you realize you've just completely blown a tire, bent the rim, the whole deal.
Yeah, that is a terrible start to the morning.
Exactly. And then the tow truck driver tells you it's going to be like $400 to fix. Now, for a lot of people listening to this, that is incredibly frustrating. It ruins your day.
Absolutely.
But according to the data we are looking at today, for 37% of Americans, that $400 expense isn't just annoying, it's an absolute crisis.
Yeah, they simply do not have the cash to cover it.
Right. And that stark reality is basically the foundation of what we're going to dive into today.
Which is really important context. Because if you look at the broader trend, 58% of U.S. adults report having the same or less emergency savings than they did just 12 months ago.
Wow, 58%.
Yeah. The financial cushion for the average consumer right now is just incredibly thin.
So to explore this, we've got a fresh Q1 2026 investor presentation from a financial services company called Enova. And the mission of this deep dive is to decode how they are completely flipping the script on who gets access to credit.
Because they operate right in the center of that exact problem you just described.
Right. And just to set the stage for you, the listener, Enova has originated over $69 billion in loans since 2004. They've served almost 15 million customers.
That is massive scale.
It is. They just posted $3.2 billion in revenue for 2025 alone. But what makes this so compelling isn't just the sheer volume of money, it's how they're deciding who gets that money.
Well, what's fascinating here is that Enova isn't targeting the ultra-wealthy. They aren't catering to the people with huge safety nets.
They're going after a totally different market.
Exactly. Their entire empire is built on the non-prime borrower.
Okay, let's unpack this. Because the traditional banking system is built for a very specific type of consumer, right?
Oh, absolutely. If you have an 800 credit score, a steady, high-paying salary, and massive savings, traditional banks will roll out the red carpet for you.
But for everyone else, it's a completely different story.
Yeah, consumers and small business owners who fall outside those rigid lines, they just get shut out.
So let's talk about those rigid lines, because almost everyone has interacted with a FICO score at some point. It's that three-digit number that acts like your permanent financial report card.
Which is incredibly stressful for a lot of people.
It is. You walk into a traditional bank, they pull that number, and the entire interaction hinges on it. So why is that system failing the people who actually need the capital the most?
Well, because traditional banking relies so heavily on those standard credit bureau scores, which are essentially rear-view mirrors.
Rear-view mirrors.
Yeah. A traditional credit score tells a lender about your past mistakes, right?
Mm-hmm.
But it is notoriously bad at understanding your current cash flow.
Oh, I see.
It doesn't show your actual real-time ability to repay a loan today. And the data from the presentation shows this clearly. If you have a credit score under 680, you're rejected 4 times more often than someone sitting between 680 and 760.
4 times more often. That's a huge drop-off.
And for small businesses, it's just as brutal. Only 42% of small businesses that apply for a loan at a large bank actually receive the full amount they requested.
Okay, I understand the rearview mirror concept, but I have to stop and push back on this a little bit.
Sure, go ahead.
Because if I'm a traditional bank manager, right, and I'm looking at someone who has 0 emergency savings and a history of missed payments, isn't denying them a loan the responsible thing to do?
That's the standard industry thinking, yes.
I mean, lending money to someone who objectively struggles with cash flow, it just sounds like a fast track to massive default rates, like you'd go out of business.
Well, that is the exact assumption that keeps traditional banks completely out of this space.
Because it's just too risky.
It's too expensive for them to figure out the risk. Traditional banks rely on human underwriters and, frankly, really legacy software.
Right.
So for them to manually dig through the complex financial life of a non-prime borrower to figure out if they're actually a good risk today.
It just takes too much time.
Exactly. The math just doesn't work for a $2,000 emergency loan. It costs them too much in overhead. So the banks just walk away. They leave the market entirely.
So they walk away, leaving behind what exactly? Like, how big is this blind spot they're ignoring?
Oh, it is massive. Enova's data outlines a $277 billion U.S. consumer loan market.
$277 billion.
And another $261 billion U.S. small business loan market.
Wow. So we're talking over $500 billion of demand here.
Half a trillion. And despite being a major player in this space for 2 decades, Enova currently holds less than 1% of those consumer balances.
Wait, less than 1%?
Yeah, and less than 1.5% of the small business market.
Yeah.
The demand is practically bottomless because the legacy institutions just refuse to participate.
Okay, so traditional banks are literally leaving $500 billion on the table because they don't have the tools to figure out who will actually pay them back.
Precisely. And this is where Enova's core technology comes in.
Right. The presentation details this proprietary system they built called the Colossus Analytics Engine.
Colossus, yeah. And we need to be clear, this isn't just a fancy spreadsheet.
No, not at all. 90% of Enova's underwriting models are driven by machine learning.
Think about the limitations of that traditional FICO score we just discussed. A FICO score is like looking at a grainy black and white photograph of someone from 3 years ago, right? And trying to guess how healthy they are today.
That's a great analogy.
Colossus, on the other hand, is like watching a 4K 3D video of their daily financial life in real time.
I love that. And to construct that 4K video, the presentation notes that Enova uses over 40 million data points just to predict the likelihood of acquiring a new customer.
40 million.
It's mind-blowing. But what exactly are those data points? Like, what is the machine learning looking at if it's ignoring the traditional credit score?
It relies heavily on what we call alternative data. So let's say a borrower has a poor traditional credit score because of, I don't know, a medical debt from 5 years ago.
Which happens all the time.
Exactly. A traditional bank software sees the low score and auto-rejects them. But Colossus bypasses that entirely.
Because it's looking at the present.
Right. It can use electronic read-only access to look at the borrower's actual bank statements today. So it sees that their rent is paid exactly on the first of the month, every single month.
Oh, wow.
It sees stable, bi-weekly direct deposits. It sees they never overdraw their checking account.
So it's looking at the actual behavior.
Exactly. The machine learning algorithm identifies thousands of these hidden microcorrelations that prove current financial stability, regardless of what the old black and white photograph says.
And it does this at a speed that a human underwriter couldn't even comprehend. Which brings me to a statistic in this Q1 presentation that frankly blew my mind.
I think I know which one you're going to mention.
85% of Enova's underwriting decisions are fully automated.
Yep.
Wait, so a computer algorithm is looking at this alternative data, making the final call, and dispersing real cash on the vast majority of these loans without a single human being ever reviewing the file.
Which naturally sounds terrifying to anyone who grew up with traditional banking.
Absolutely terrifying. It sounds like you're just opening the vault and letting an algorithm throw money out the window.
Yeah.
How does this not lead to catastrophic defaults?
If we connect this to the bigger picture, a machine learning model doesn't get tired. It doesn't get cranky at 4:00 p.m. on a Friday.
Yeah.
It doesn't hold subconscious biases about where an applicant lives or what industry a small business operates in. It just runs the cold, hard math on millions of historical outcomes.
And I guess the data validates that approach, right?
It absolutely does. These machine learning models provide a 40% improvement in repayment predictability compared to using traditional credit bureau scores alone.
A 40% edge. I mean, if you are 40% better at knowing who is actually going to pay you back, you have fundamentally changed the economics of lending.
You have entirely de-risked a population that everyone else thinks is toxic.
And what about the other 15%, the loans that aren't fully automated?
So those are the ones that maybe have conflicting data and need a second look. But even then, the machine learning is still doing the heavy lifting.
How so?
Well, Colossus auto-verifies over 80% of those complex applications using real-time electronic bank and employment data.
Got it.
So it tees it up perfectly for a human to just step in and make a really quick final decision.
That's incredibly efficient.
And it gets better. If a loan does happen to go bad, the AI doesn't just stop. It actually optimizes their collection strategies.
Oh, really?
Yeah, it tells the system exactly when and how to contact a borrower to maximize the yield on recovering that debt.
Which flows perfectly into how the borrower actually experiences all this.
Yeah.
Because if you're someone who needs cash quickly for an emergency.
Like for that blown tire.
Exactly. The last thing you want to do is drive to a brick-and-mortar bank, sit in some brightly lit cubicle, and publicly plead your case to a loan officer who is silently judging you.
Nobody wants to do that.
Right. But Enova operates purely online. You just apply from your phone in total privacy.
And that matches consumer behavior perfectly. The industry data in the presentation shows that 54% of bank customers now use mobile apps as their absolute top option for interacting with their finances.
It's just how we do things now.
Right. But from Enova's side, being purely online provides a massive structural advantage.
No physical branches.
Exactly. They don't have to pay rent on thousands of physical bank branches. They don't have to pay for utilities or physical security. They have stripped out all those fixed costs of traditional banking.
Which gives them incredible agility.
Right. They can scale up or scale down their operations instantly based on macroeconomic conditions.
Okay, here's where it gets really interesting. This sets up the biggest strategic pivot in the entire presentation.
The acquisition.
Yeah, we have this sleek, online-only fintech company running a highly advanced artificial intelligence to originate loans. So why, in late 2025, did Enova announce an agreement to buy Grasshopper Bancorp?
It seems counterintuitive.
Right, it does. Why take a pure technology company and chain it to a highly regulated traditional bank charter?
Well, to understand the brilliance of this move, you have to understand the biggest bottleneck for any massive lending operation.
Okay, what is it?
You have this incredible AI engine that knows exactly who to lend to, but you still need the raw material.
Yeah.
You need billions of dollars in actual cash to hand out to these borrowers.
Right, I mean, before you can lend money, you have to get the money from somewhere. Where has Enova been getting it up until now?
Historically, companies like Enova rely heavily on the securitization markets.
The securitization markets. Okay, explain that.
It's a complex Wall Street mechanism. Basically, Enova originates thousands of loans, bundles them all together into a package, and then essentially sells that package to institutional investors,
Yeah.
like hedge funds or pension funds.
So they sell the loans to get their cash back so they can lend it out again?
Exactly.
But those Wall Street investors aren't doing it for charity. They demand a return.
They absolutely do. And because Enova is lending to non-prime borrowers, Wall Street views those bundled loans as risky.
Even with the AI.
Even with the AI. So Wall Street demands a very high premium. Enova has to pay a massive amount of interest just to borrow the money they're lending out.
Which eats into their profit margins severely. Okay, so let's bring it back to buying Grasshopper Bancorp. Grasshopper is a digital-first bank, but crucially, it has a national bank charter. How does that fix the Wall Street problem?
A bank charter legally allows you to take in everyday consumer deposits.
Like checking accounts and savings accounts.
Exactly. Checking accounts, savings accounts, certificates of deposits. Suddenly, Enova doesn't have to go beg Wall Street hedge funds for expensive capital.
Oh, wow.
They can just use the everyday deposits sitting in Grasshopper's checking accounts to fund their loans.
It's like a company that builds the best electric vehicles in the world, but they've been forced to buy their batteries from a third-party broker who charges a massive markup.
That's a perfect way to look at it.
Buying Grasshopper is like finally building their own battery factory. They control the raw material, and the math on this is staggering. The presentation notes that Grasshopper's deposit costs are 300 to 400 basis points lower than the cost of Enova's usual securitizations.
And just for anyone not deep in financial jargon, 300 to 400 basis points basically means 3 to 4 full percentage points.
Right.
In the world of billions of dollars of lending, lowering your cost of capital by 4% is an absolute earthquake on the balance sheet.
It translates directly to the bottom line. I mean, Enova expects this acquisition, which should close in the second half of 2026, to generate $175 million to $230 million in revenue synergies within the first 2 years alone.
It's huge.
They are projecting an immediate jump in their adjusted earnings per share, which is a key metric for profitability, right? By over 15% in year one, scaling up to a 25% boost beyond that. And they get the added bonus of a unified federal regulatory framework.
Right, rather than dealing with 50 different sets of state lending laws.
So it's just much simpler.
It's a textbook example of vertical integration. They have perfected the demand side with Colossus, finding the good borrowers. And now, with Grasshopper, they are perfecting the supply side, securing the cheapest possible capital to fund those borrowers.
Right. All of this strategy sounds incredible in a boardroom presentation. But the ultimate test is whether it actually works in the real economy.
Let's look at the numbers.
Let's do it. We have the actual Q1 2026 scorecard they just released. How are they performing right now?
The Q1 numbers completely validate the entire thesis. Their total originations for the first quarter hit $2.3 billion.
Oh.
That is a 33% increase compared to the same time last year, and their ending receivables reached $5.3 billion.
Okay, walk me through what ending receivables actually means for the health of the business. Because, originating a lot of loans is easy.
Yeah.
I could literally stand on a street corner and hand out $2 billion today. That doesn't mean I have a good business. It just means I'm giving away money.
Very true.
So how do we know these billions of dollars in receivables are actually going to turn into profit?
This raises an important question, and it's the most critical one in non-prime lending. You find the answer by looking at their margins. Enova reported a 60% consolidated net revenue margin for the quarter.
Wait, 60%?
Yeah, and that is up 3 full percentage points year over year.
A 60% margin is massive.
It is, and what that margin tells you is that they aren't just pumping up their origination numbers by handing cash to anyone who asks. The loans they're making are actually performing.
So people are paying them back.
They're paying them back with interest at a rate that far exceeds the cost of defaults. That margin expansion is the ultimate proof that the Colossus machine learning algorithm is doing exactly what it was designed to do.
Which is accurately price risk in a volatile demographic.
Exactly.
And on top of that, their adjusted earnings per share grew 30% year over year to $3.87. So they are originating more loans, they're making a higher margin on those loans, and the profits are flowing directly to the bottom line.
But here's the catch.
There's always a catch.
Despite these numbers, the presentation points out a massive disconnect in how the stock market is valuing the company.
Really? Why is that?
Well, this is where market psychology comes into play. Price to earnings, or PE ratio, is essentially Wall Street's confidence score in a company.
Okay.
The broader Russell 2000 index, which tracks small-cap companies, currently trades at a PE ratio of 17.2.
Right.
Enova is trading at a PE of just 7.4.
Wait, really? So the market is looking at Ennova's earnings and discounting them heavily?
Very heavily.
But why? If the AI is working and the profits are up 30%, why is Wall Street treating them like a risky bet?
Because Wall Street has severe institutional trauma from the 2008 subprime mortgage crisis.
Ah, the word non-prime.
Exactly. When many traditional analysts see the words non-prime lending, they immediately assume a high risk of catastrophic default the moment the economy wobbles.
Even with all this new technology.
Right. The market is valuing Enova like a legacy subprime lender. They are completely failing to factor in the predictive power of the Colossus AI, and they're severely underestimating the massive profitability boost that's about to hit when the Grasshopper Bank charter lowers their cost of capital.
So the market is essentially looking at the old black and white photograph, while Enova is out there operating in 4K.
That's exactly it.
Okay, let's synthesize the journey we've taken through this presentation today. We started with a very real problem. Millions of Americans and small businesses who are effectively locked out of the financial system because a 3-digit FICO score says they are too risky.
Right. And we saw how Enova solved that by building a machine learning engine trained on alternative data that predicts a borrower's actual ability to repay a loan 40% better than the legacy system.
And finally, we explored the structural masterstroke, right? Acquiring a digital bank charter to replace highly expensive Wall Street funding with cheap, reliable, everyday deposits. It just completely insulates their business model.
And it highlights a fascinating dual mission. Enova states plainly in this document that their goal is closing the world's credit gap.
Right.
But they aren't a charity. They are generating top-tier financial returns while doing it. The integration of cutting-edge technology and structural banking evolution proves that massive financial inclusion and intense profitability don't actually have to be mutually exclusive.
Thank you for taking this journey with us today. I really want to leave you with something to consider long after you finish listening.
Definitely.
We've talked extensively about how rigid and outdated the traditional FICO credit score is. If a machine learning algorithm quietly analyzing your digital behavior, your cash flow, and thousands of alternative data points can predict your financial reliability 40% better than a credit bureau.
Makes you wonder.
It really does. How much longer will the traditional credit score even exist? And perhaps more importantly, if the future of our ability to get a mortgage, buy a car, or start a business relies entirely on a proprietary black box AI tracking our daily digital footprint.
What does that mean for our financial privacy going forward?
Exactly. It's a vital question as this technology becomes the new standard. Think about that the next time you tap your phone to pay for something. Until next time.